We're officially live on YouTube for the Tuesday edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, to talk about this idea of Christmas cash versus retirement income. Fresh out of he's about to do the Jordan flu game, everybody. His name, we call him GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And with us, as always, in the chat, making sure that you got everything you need, is our amazing community manager. We call her MTM because she brings us the moment that matters. And because her name is Madison the Magnificent. Say hello, Madison.
Hello, everybody.
Awesome. Awesome. We are pumped up to start this show today. As we talked about, right, we are talking about this idea that we have long kind of had to clarify over and over again, which is the cash flow today versus cash flow tomorrow. There is no time more pressing for cash flow than it feels like the holidays. So we're calling it Christmas cash. But before that, if you're watching on the YouTube, if you're listening on the podcast, we love having you here in the audience, but you're about to realize that this is a live show and we've got a live community that's hanging out here in the chat. So the best thing to do to join that, which is the best experience, maybe a New Year's resolution for 2023, is go to nyais.com, sign up there, put it on your calendar, join us and be part of what, GC?
The roll call, baby.
The roll call. We got Denny Davis with a Guten Christmas. Denny Davis, welcome from Germany. We got Madison welcoming everybody. We got Lee, the MVP Bishop, MVP of our community, saying hello, everyone, happy holidays. We got John Hanning, our usual leadoff hitter, batting third today. I like that, John Hanning. Important part of the lineup. We got the other Greg, the number one Greg, Greg Stone. Howdy from New Jersey. We got the early bird, Dean Curry, wishing us a Merry Christmas from Columbus, Ohio. We got Shannon Baker is back in the house. Shannon, good to have you in here. Hello, everyone. Hope you're ready for the holidays. Kind of. We got, who'd you see? Aaron O'Neill.
Into the light.
Aaron O'Neill, our favorite name to pronounce out here. Good to see you, Aaron. We got Nadeem Shah with his trademark good morning, good afternoon, JWB from the West Coast. We got Chris Gonzaga from the illustrious Hudson Valley of the state of New York. Illustrious over there. We got a not your average guest. That means somebody's clicking in from the text messages. It's working, making it easy for you. But we don't know what your name is unless you change it from not your average guest to your name and the character things. Maybe Madison can help you out with that. We got David Blattner in the house checking in, saying hi, everybody. We got Tony D from Jupiter, Florida, saying hi, everybody. We got Bill Shields with his trademark. Feliz Navidad, amigos. Bill Shields checking in. Good to have you. We got Christopher Lee from Fernandina Beach, making it a habit out here, Chris. I like it, man. Who else we got out here? Just checking in. Oh, look at that. We got the first family in the house. The patriarch and matriarch, Ken and Carolyn Moline, and Duchess Karen.
We salute you.
We salute you. Is Greg at home? Greg is in the JWB condo where they host their meetings, right?
Yes, every Wednesday. This is where my business partners and I escape to. We lock ourselves in this beach condo that we have. We work out of here. So this is where we are on Wednesdays.
Yeah, there you go. We got the ringmaster, Drew Barnhill, in the house saying good afternoon, all, happy holidays. Who else we got? Just scrolling through. This is a good roll call today. Oh, look at that. We got Sir Peter James from Seasons. Greetings from the great Commonwealth. He rebukes the illness from GC. Madison and Pablo are the best. Jen is special. Lots of love from Peter T. James.
Tip of the cap to you, my friend.
Sir. What a gentleman. We got Eddie Harris from Hotlanta in the house hanging out. Pablo, what is the background? Looks nice. Greg, I'm in Miami for the holidays. Mm-hmm. And I am in my best friend's apartment. This is the view from his balcony. So whenever I host it from here, I like to show tribute. I literally just took that picture, and that's really what it looks like. We got Marilyn Cotterman from Homosassa, Florida.
Very well done. That is the home of the manatees, if anybody was unaware.
Home of the manatees, Florida.
I missed that.
We got Gary Riley in the house. Gary and the regular Rosalind Riley from Marietta, California. Good to have y'all back. We got Melissa Matthews saying hi, everybody. We got Sanket Gupta saying hello, everybody. We got the fairy godmother in the house, Jen Filzen. Greetings from the beautiful Monterey Peninsula. This is all the regulars are here, man. This is awesome. I think I'm going to be able to go on forever with this roll call. Okay, cool. Jen likes the ho, 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 homosassa. Me too. It's the holiday greeting over there. All right, GC, let's kick this off, man. I know that you are with illness, but you are ready to show up because this is a topic near and dear to your heart. What is the deal here, man? Why do we need to talk about Christmas cash versus retirement income?
Well, I think it really matters. I think at a time like this, especially going into what many people expect to be recessionary time, real income really matters. And there are certain assets that produce income. There are certain assets that don't. There are certain assets that tend to produce more returns over time, right? You might be backloaded. You might be looking at your investment and say, okay, well, if I hold on, then I might make more over time. And then there are some assets that gain income and gain profit centers over time. And there's such a misnomer, there's such a lack of understanding on how to evaluate those asset classes. What I'm hinting at here is rental properties versus stocks and bonds. And so what I wanted to do, and what I was prompted to do by our incredible host over there, that good looking gentleman right there, is to really kind of break down and put numbers to cash flow today versus cash flow tomorrow, to put numbers to the asset of investing in the stock market versus investing in bonds versus investing in rental properties, and to show over time how those numbers may change. And I'm just so excited. Yeah, I'm a little sick here, but I'm way more fired up to talk about this because I haven't actually put the numbers to this in quite a long time. You know, I live and breathe and eat and drink this stuff, but I haven't put the numbers to it. And as I was putting the numbers to it over the last couple of days, I was just really fired up to bring it to you guys because I think it is going to be a very clear depiction of why this asset class wins over the long haul compared to the typical average asset classes out there.
I love it, man. To me, I take my role very seriously here as the voice of the customer because I am one, right? And I'm always out there in the market, kind of like testing these assumptions that I've learned and testing the stuff that I'm hearing here. And I think this became very clear to me when, for the first time ever, because we've been on a bull run, right? Like we've been on a 14-year rising stock market, everything doing well. For the first time ever, I remember it was about like 6 months ago, my dad was driving through Jacksonville and he was telling me, he's like, yeah, man, oh no, I remember what it was. It was because I was going to see if I could borrow some money from my dad to get my third rental property, right? Like, and I remember, I talked to Gregg about this idea of like, man, how do I have this conversation? Because you've done this. And I knew that I could do a good deal for him. And the conversation was fine, but something unexpected happened. He was just like, listen, man, if you would have told me this a month ago, it would have made much more sense for me. But I'm in my retirement. I'm on this fixed income. The market just took a dive. So my regular income that's coming in isn't really, feeling very certain. And this was back in January, right? Like this was before the market really started going down. Like it just kind of took a dip. And that's when it hit me that cash flow today is very different than cash flow tomorrow. And this idea that my dad's done so well for his life and he has, dutifully saved and put stuff where the average investor does and done it the right way, the average way. And yet here he is at 77 and thinking to himself that the thing that he has worked 70 plus years to amass, which has been significant, is now less stable than what he really wanted. Like at the level of success he's had and at the level of like rigor that he's put into all of this, it didn't make a lot of sense to me that, now because the stock market dips, he's paying consequences. So this was when I started really questioning you about this idea of how can we help people understand that, yes, cash flows are compressing right now in the Jacksonville market, but most of us, or at least there's a large section of us here that aren't thinking about this retirement, this play as the thing that's going to pay my cell phone bill today, even though you can, right? But what we are thinking about is how can we get to a certain age, have a certain net worth, and be able to live off of that net worth in a way that affords me the options and the lifestyle and everything that I deserve because of all the hard work and all the planning that I did. And that was kind of the challenge that I've been like pushing you on. And it only took about 11 months, but I'm really pumped. I'm really pumped to have it right now, Steve.
Better late than never.
Better late than never. Better late than never. All in due time. So, that's kind of it, right? Like, so when I think about at the crux of the problem here is the idea that we are looking, right now, most of us that are investing right now are still earning income. We're still able to, have these different options. And we've been told, or at least I was told well before, until I joined this community, that, like that old ING commercial, there's this magical number that you're supposed to get to. And that magical number might sound daunting when you're young. It might sound a little less daunting when you're older. It might still be daunting, but as long as you're able to reach it, then you're going to be okay. And I believe that until I saw the data point that says, wait a minute, if that's what you're doing, it may not be okay, because here's somebody that definitely reached that number and surpassed that number. And it's telling me that, there's something wrong here. And then I added on the idea that we're living longer, right? Like if we're going to retire at 66 or 60, whatever, like my dad retired at like 72 with, and the idea that we're going to live through an economic downturn or a bull market at some point during our retirement years is very, very real. So how do we make it so that we don't put ourselves in that position is kind of the question that I'm asking today.
I love it, man. I love everything you said. As I was listening to you, and I know we've talked a little bit about your dad, I just think if there is one investor out there who deserves to have peace of mind as he's 77 years old, it's probably your dad. Worked so hard, right? Done so many good things, smart dude, right? And, he doesn't have that peace of mind. There's a lot of other investors out there that haven't done things as well as he has. And so if the normal way of investing, the average way of investing isn't exactly working for your dad, who's it working for? Is my question, right? There's a different way. There is an alternative way to think about this. And what I'm excited to do today is just break down the myths. I mean, there are so many reasons that people say, don't invest in this rental property. There's not enough cash flow. It's too hard. You name it. There's a million excuses. And so I wanted to take all those excuses, put them all on the table here, show you a rental property that has zero cash flow, and compare that to that same decision you could have made investing in the stock market or investing in bonds. But extrapolate this. Go out 20 years from making that decision. Go out 30 years from that decision and see how you really will fare.
Love it, dude. Where do we start, GC? Should we just start talking about kind of like what people see in the average investments of stocks and bonds?
Yeah. Well, let's go into on face value what people say about the stock market, bonds, and rental properties. And I would love for the community to chime in here if you all have some thoughts or questions, right? My opinion is if you talk to people, on the streets and you ask them what's a better investment, people will largely say, well, listen, I'm going to make more money in the stock market than in bonds. They may say that in real estate, you can make a lot of money, but it's not an overwhelming win. And they would basically say, well, I'm probably going to make about the same amount of money in the stock market as I would in owning real estate or in rental properties, at least passively. And they'll say, well, it's just not worth the headache. So I'm just going to stick to the stock market because it's easier and there's not enough of an advantage for me to learn something different. Do you feel like that's maybe just a summation of how an average investor would think?
Yeah, totally, man. When I talk to my friends about this thing that I'm doing, at least when I first started talking to them, before I really knew it, it was just like, man, it's too hard to do it the other way. This stuff, I can just kind of like cover my eyes. I know I'm going to get like 7 to 8% long term, let that thing compound, right? It's just kind of taking the simple route, right?
Yeah. And I think for somebody to move from maybe the average way of doing it, you would either have to see a huge benefit, maybe make a lot more money, or you would have to see that it would be so much easier than what you were expecting in rental properties. And somewhere along the line, the average investor out there does not see either of those. And so that's why they continue to do the same thing, even though we know that the stock market is incredibly volatile. And, if you are, it doesn't always happen when you're 77 like your dad, but, you generally have a bear market happen, call it once a decade. or less than that, right? So if you are in your 50s and 60s and 70s, you are going to deal with volatility and pain. And, so what is really interesting is people say, well, that's okay. I'm going to deal with that when it gets there. I'm going to keep putting my money in the stock market. So what I wanted to do is let's go back and let's see if you made that same decision 20 years ago. Now that we have the benefit of hindsight and we see how this has actually played out, you had the decision to invest in the stock market, and you just bought a share of the S&P 500 index, or you invested in a bond, and I chose the US Treasury, 30-year US Treasury bond, or you had the option to invest in a rental property in Jacksonville, Florida. This is what you would have seen on the surface. All right. So for the stock market, and I'm being as I don't know, I'm trying to give everything I can to the other asset classes, and I'm trying to take away as much as I can from the rental property investment to prove a point here. Generally, if you look in the stock in the S&P 500, your dividend is somewhere between maybe 1.5% to 2%. And so I said, okay, well, 20 years ago, your dividend would have been about 2%. That means for the amount of money that you put into the stock market, into the S&P 500, you would get about 2% of that each year as income to you. That's your dividend. All right.
Mm-hmm.
If we keep going down the line, I also went and I looked at asset appreciation. So in the stock market, how much did the S&P 500 go up in the last 20 years? This is great. We can see the data. And if you look year over year, on average, the stock market went up 7.6% per year. All right. Now let's take a look at bonds. So if I actually went back and I looked at the 30-year US Treasury in 2002, and that was paying a 5% coupon, which is the same thing as yield, dividend, positive cash flow. It's all the same stuff in essence, right? It's money that's coming to you. So you would have earned 5% per year if you bought that bond. Now, the way bonds work is if you hold them to maturity, right, you get your original principal back. You made all that money in the coupon or the cash flow along the way, but you don't get asset appreciation in a bond. You just get all of your principal back later on. So if you look at asset price appreciation over those 20 years, you don't have asset price appreciation. You held it to maturity, right?
Yep.
And then if you look at rental properties, so I actually went back and I did the research here for the Jacksonville market. And I just assumed that you got 0% positive cash flow, like 0% cash on cash return. That's a term that people use to evaluate how much money you receive in positive cash flow for a rental property and for other assets, but for rental properties, it's used. And let's just assume that this is break even. You're not getting any positive cash flow from this investment. It's 0% cash on cash, right?
Mm-hmm.
And then I looked at what the asset price appreciation is for the Jacksonville real estate market from 2002 to 2022. It appreciated 5.2% per year. That's real numbers. Wow. So Pablo, when you're looking at this, what do you think the best investment is? What do you think the worst investment? Like, what's the clear winner here?
I mean, when I'm looking at this, just as a layman looking at these numbers, stocks of 2% with asset price appreciation of 7.6% looks pretty good.
Yeah, absolutely.
Yeah.
That's the clear winner.
Yeah.
Right. Yeah. Now, bonds, you would say, well, the bond investor would say, well, income is more important to me and preservation of capital. So you would say for a certain section of the population that bonds would play a role. And so the typical portfolio, the way that most standard financial advisors build a portfolio of stocks and bonds is they typically put 60% of the capital into stocks and 40% into bonds. And then over time, they switch that maybe to 60% bonds, 40% stocks, or maybe getting to 80-20, but that's how they sort of allocate this, and they keep it within that sphere. Rental properties don't look very attractive here, do they?
No, doesn't look that attractive.
So we can understand why average investors, the people you talk to on the street here, keep their money in the stock market and in bonds and don't see the big advantages that come from owning a rental property. It's pretty clear here.
Yep. Yeah. Totally, man. So what are we? Okay. I look at this and I see that this is the average view, right? Like this screams to me the normal conversation that I get in, and the reason why people are like, yeah, man, why would I do this?
Yeah. So let's take a look. Let's dive a little bit deeper, because this on the surface is exactly what people are thinking, but there's so much missed. And that's what we're going to dive into right now.
Let's dive in.
So what I did next was I actually broke down each of the profit centers. And of course, when we're talking about dividend or yield or cash on cash return, that's only one of the profit centers. When we're talking about asset price appreciation, that's another profit center, right? But in rental property investing, there's actually 5 profit centers, of which I only put 4 on here for simplicity's sake. But I actually broke it down. There's so much hidden benefits when it comes to owning rental properties. And we're going to compare this asset to asset if you had invested in each one of these 20 years ago. And let's just say that you had $35,000 to invest 20 years ago. How would this have turned out? And these numbers are staggering. For those who are watching live right now, you're seeing some large numbers, and you're seeing the punchline even before I get to it. But we're going to break it down, right?
Yep.
On the stock side, you would have seen positive cash flow or dividend of $14,000, which is really nice. We like that. That's that 2% dividend. You would not have seen any tax savings. You would not have seen any principal pay down, and you would have seen asset price appreciation minus any selling costs of about $116,000 for a total return on investment of about $130,000. Sounds pretty great, huh, Pablo?
Sounds pretty good, man.
Let's compare that to the bonds, right? If you invested in a 30-year US Treasury and you bought that 20 years ago, you would have received $35,000 in cash flow. There's your 5% coupon. You don't get any extra tax savings from that. You don't have any principal pay down from that, and you don't have any asset price appreciation. So your total return on investment would be $35,000.
Doesn't look as good.
Doesn't look as good. You do that if you want to be conservative and if you value income, and quite honestly, you don't have any other better options. You're not a part of a community like this. Now, Pablo, let's take a look at that last line item right there, brother.
It's looking juicy, man. It's looking juicy. Talk me through this line item.
Well, let's first start with positive cash flow, right? I just said day one, you had $0. You had a 0% cash on cash return. It was break even when you bought that rental property. How do you have $31,909 in positive cash flow from the same property you bought 20 years ago?
Say it again. My engaging in 2 conversations caught up to me. I'm sorry.
So day one, right? Go back to that slide that we had previously.
Okay.
So day one for Jack's rental property investment, it says 0% cash on cash. That's the same thing as saying there is a $0 positive cash flow coming from this rental property. The rent that you make on that is gobbled up by the expenses that you have on it, and it's break even.
Got it. Okay, now I know. So how do we get to this much positive cash flow?
Yeah.
Increased rents.
There you go. There you go. It's not just increased rents, right? It's increased rents, and one of your biggest expenses stays the same. What's the biggest expense that stays the same?
Your mortgage.
Your mortgage. So your income is going up, and I chose 3.3% per year because that's the historical average in Jacksonville. But one of your biggest expenses is staying flat. Huge value there. Now, your other expenses are going up as well, right? You've got property taxes, property insurance costs, maintenance costs, things of that nature. We assumed all of those went up 3%. And you can see all these assumptions labeled below. But the big thing here is cash flow immediately does not tell the final story for rental properties. And that's why I sing this from the rooftops, and I tell people, stop paying so much attention to day one cash flow.
Well, GC, let's stop 1 second, because Sanket says, yeah, but rents may go up and mortgage rates stay the same, mortgage payment stays the same, but property taxes and insurance also goes up. What do you say about that?
I'd say that he's right. And we've actually built that into this model here. So all the operational expenses like property taxes, insurance, maintenance costs, the property management fees, they all go up by a factor of 3%. And you still wind up with this much positive cash flow after holding on to this asset for 20 years.
Cool. Love it.
So let me ask you, for all those investors out there that are saying, well, I really love the Jacksonville market. I really love the JWB team, but you know what? I'm not going to get $200 a month in cash flow, like I might get in Cleveland. I might get $100 a month in cash flow. Like, they are giving up the right team and they are giving up the right market for $100 of cash flow, which is not substantially going to change these numbers after 20 years, right? Do you want your entire decision being based on cash flow? Probably not.
Probably not. Why so though, GC? Why is it that you don't want it based on cash?
Well, because number one, the team is the one that actually controls the experience. So if you're going to hang around for 20 years in this investment, you need to make sure you have a positive experience. That's number one. Number two, the market you choose really dictates these other asset classes as well. And just like we talk about all the time, Pablo, the greatest percentage of your overall return on investment is not going to come from positive cash flow. Yet this is what the vast majority of average rental property investors cling to as the number one thing for them to make a decision.
Yeah. So what I find interesting about this, GC, and I was I was relaying this story that I want to go into depth with probably on Thursday at the POTW, because I had this like awesome conversation with one of my best friends here yesterday about something that's related to this. So I look at this chart and I think, oh, okay. Well, not only is the cash flow tomorrow better in 20 years, right? Because I am now getting this like 31,909 instead of 14,000, and getting the tax savings and this principal pay down. And I'm beating the pants out of it in the asset appreciation as well, if I'm investing in a growth market like Jacksonville. But I look at this, thanks to being part of this community, I now look at this like asset appreciation and this principal pay down. I now am trained to add these things up and understand that I now have $236,000 in equity that I'm able to use creatively, either by refinancing or taking some kind of like home equity line, or, multiple other levers that allow me to not just have this positive cash flow stuff going, but also leverage this kind of principal pay down and asset appreciation into kind of like what Hervé did, who has shown it, right? He turned 3 homes into 6 homes like 3 years later. And now he's turning those 6 homes into like another whatever amount that he's doing, right? Like that to me is the stuff that starts getting really, really interesting for me when we're talking about this 20 years out.
It's amazing, man. I mean, this is just the tip of the iceberg. We're just looking at the returns here, but you can double down on this investment in rental properties so much easier than you can in other assets, right? Yeah. Like, for example, even if you have a great run in the stock market, you're not going to be able to take out a loan against the appreciation of the stock price that you received. Whereas you can do that in rental properties. And then you go out there and you borrow more smart debt, use other people's money, and you double down on this same theory and this same application. And that's why this is so influential. This is why, and what I'm showing here is why there have been more millionaires created in rental properties and in real estate than any other asset class. I mean, it's just not happening in the stock market or in bonds, but it does happen in rental properties and in real estate. And this is what you're seeing.
Yeah, it makes sense. And like, to me, I would go deeper into explaining what you mean by double down, right? Like, for me, it's like, if you were to want to take the profits that you made from this stock market stuff, right? Like, if you were to be like, all right, now I want to double down on stocks, what that means is you'd have to come off of the stocks that you already own, cash it out, pay some kind of taxes on it, and then go pick another growth stock that's going to perform like that for 20 years, or growth portfolio that's going to perform like that for 20 years. Whereas this rental property, you get to keep the home, right? You get to, continue with that positive cash flow and appreciation in that asset, but still take this money off the table, take some of this money not off the table. You just get lent that money to then go invest in other things that are going to appreciate the same exact way. I mean, that to me is like, man, if people get to understand that part, it's just amazing how few people understand that part.
100%. Right. In that example right there, in the stock market, you have to pay a lot of taxes. And in rental properties, it's not hard to come up with a way for you to access the growth here and pay 0 taxes. The easiest way for you to access the equity here that you've built up, the growth that you've built up, is through a refinance.
Yeah.
When you refinance out, you pay $0 in taxes on the cash out that you pull out of this investment. And it's a
Yeah.
beautiful thing, right? And then there's other strategies to limit your tax liability here. So there's so much more flexibility here. I mean, but I think the biggest thing that we haven't even talked about here is the difference in the total returns.
Oh yeah, there's that too.
Yeah, right. I mean, let's just put bonds to the side. Everybody understands that you're not going to get ahead investing in bonds, right?
Go home bonds.
Go home bonds, go home. But the stock market is where people put the vast majority of their investable assets, especially when they're young, right? This is one property that you held on to for 20 years. And the difference, and I'm not using pie in the sky numbers here, I'm using actual data here. This property would have earned $330,000 in total returns across all of those profit centers compared to the stock market, which would have earned, or which did earn, 130,000. So $200,000 more across these other profit centers. But why does this happen? How could you go from the first slide that we talked about, where it looked like the worst investment of the three, to clearly being the best investment of the three after a 20-year hold? Let's break this down. Why is that, Pablo? What do you got?
I mean,
Did I catch you again?
no, no. I'm in. I just feel like that's exactly what we talked about. It's the 5 profit centers, right? It's the idea that you are investing in this asset class that pays you 5 ways as opposed to 1 way, right? Like stock, I guess 2 ways for stocks. Stocks will pay you in some kind of cash flow with dividends, and then in that appreciation, it pays you, while this thing pays you through the cash flow, through the tax savings, through the principal pay down. And oh, by the way, the asset appreciation, which, is a certain number, and that number gets magnified if you're leveraging that the debt as well, right? Like you are, yeah. So like in this example, if we're talking about, I guess we were talking about 35 G's that you're putting down.
Mm-hmm.
Yeah. So in this one, you're putting down 35 G's to get $35,000 worth of stock. In the property investment, you're putting down 35 G's to get $120,000, whatever, worth of stock, right? Like worth of house stock. So, I mean, that makes perfect sense right there.
I think we need to sit there for just a second, because
Okay.
there's 2 main reasons why this works out this way. The first one, and credit to David Blattner, and others may have said this too, I just saw his comment in the chat, comes down to leverage, right? Smart debt means that you're investing in assets that appreciate over time. And if you have an opportunity to invest in something that goes up over time, and you have the opportunity to borrow somebody else's money to acquire that will juice your return on investment substantially. And so that's how you can take an asset. And again, Pablo, if you go to the previous slide there, that's how you can take an asset like a Jacksonville and rental property, which the asset technically appreciated 5.2% per year. But what you can do is borrow. You can borrow other people's money. And so if you take that 5% return, let's just call it that 5.2% return, I'm gonna call it 5%, and you only put 25% down, it's like you multiply that 5% return times 4. And so that 5% return becomes 20%. And that's why home price appreciation, even though it's 5%, which is less than stock appreciation over that same time period, doesn't matter, because we have the benefit of leverage in rental properties, and you do not have that in the stock market. And that's a big, big difference. That's the number 1 reason why rental properties win over the long haul.
Yeah, that magic of leverage was kind of the first huge aha moment for me in like being able to explain this thing. And it's so powerful to think that you can gain the benefits from someone else's money, right? Like that is responsibly placed in the thing that they would want it placed, but you are benefiting from like creating this greater value equation by owning this thing, giving somebody a home, and being able to like outsource it to a great operator. To me was the first mind-blowing thing before I even started thinking like a money engineer and talking about all this like refinancing down the line too, man.
Yeah, that's the first, and I remember the same for me. This was 17 years ago now. It was like this aha moment where I was like, okay, if I'm this financial engineer, my goal really is, how do I convince somebody to let me borrow their money and pay them a decent rate of return? And on that money, without taking a lot of risk, how do I earn 2, 3, 4 times that return. If I can do that over and over and over again and be disciplined and do that for 5 years, 10 years, 15 years, that's how I can control my time and do what I want to do when I want to do it with whomever I want to do it with. I have to understand the power of borrowing money at a responsible rate. Call that a 5% return, 5% interest rate. If I can convince somebody to give me their money and I'll pay them 5%, but I have something that is risk mitigated, that is going to return 10% or 15%, or maybe even more, I want to do that bet all day, every day, and twice on Sunday. Yeah. Right? That's what got me fired up about rental property investing. And that's what all of you are doing when you take out smart debt, right? It's this whole theory of like, how am I going to get somebody to let me borrow that? That's the banking system. That's the mortgage system. It's supplemented by Fannie Mae, which is a quasi-government entity. Like the government and the banking system is set up to allow you to do this. Yeah. We don't have this opportunity if you go to another country, right? It is such a special moment. So if you constantly just think about your job here as a financial engineer is to acquire assets that allow you to make a spread without taking a lot of risk on what you're borrowing versus what you're earning, you're going to set yourself up for financial security.
I get it, man. So Sanka had said something in the chat here that I think everybody's thinking, and I should have started to invest in rentals earlier, right? I think we all feel the same way, no matter what age you started in. But Dean is asking straight up here in the Q&A, what if someone doesn't have 20 years to wait? Is there a shorter term opportunity in REI? Asking for a friend. Great question.
And I hear this as well, as far as like when we talk about 20 years out, it becomes a little bit daunting, right? None of us like to make 20-year decisions. But the beautiful thing here with rental properties is this makes sense years 1 through 5. This makes sense years 5 through 10. It's like it's gaining incrementally on all of these profit centers, right? So if you look at the return on investment in 5 years out, 10 years out, 15 years out, right? You're still winning compared to these other asset classes like the stock market and in bonds, right? So it's not like it's just all the way at the end, you get this big lump of return, right? You're incrementally winning each and every year. And there's a ton of flexibility like we just talked about as well, whether that's refinancing along the way, whether that is, of course, selling if you need to sell at a time at 5 years or 10 years, you can do that in rental properties, right? It's not this like unbelievably difficult thing to sell a property at the 5-year mark. I will give one caveat though. You win the most when you hold the longest. And if you're not holding on for at least a full market cycle, some of the equations should change here. And the biggest equation that should change is the expected return from home price appreciation. If you're investing for less than 10 years, you shouldn't count on home price appreciation. That doesn't mean it's not going to happen. It just means that I'm not so confident that it's always going to be roughly what it was for the last 40 years, right? So home price appreciation in the short run is an X factor. If you can buy and hold for 10 to 20 years, then you can count on home price appreciation. You can use the historical average. Let me just make one more connection here. Some people hear that and they say, well, I'm not going to invest for 10 years, so it doesn't make sense for me to do that. If you run the numbers and you just put a lesser amount of home price appreciation than maybe what happened for the last 40 years, right? Maybe you put 1% appreciation or 2%, something that is pretty typical to happen over a 10-year period of time, you're still going to beat the stock market. So just go more conservative with that appreciation number to the point where, listen, if you're investing today and planning on selling tomorrow, don't count on any appreciation just because it's going to get eaten up with selling costs. But it's not this thing where it's like it only makes sense at year 10 or it only makes sense at year 20. It makes sense all along the way. Just have to get more conservative with the home price appreciation number.
Makes sense, man. All right, so let's look forward 10 years, GC. I know you put this slide together as well.
Yeah, and so I think this is what the original idea was when you came to me and said, hey, let's put a show together for this. It was like, what will it be like at the 30-year mark? 30 years from the original investment. And that's kind of like this, retirement income that we're talking about. And let's see what the changes are between these asset classes. And for me, what I see when I look at this is that man, if there's ever been a time to not judge a book by its cover, it's between these three asset classes. Because here in the stock market, that 2% dividend, assuming it doesn't change, right? It could go down to 1%, it could go up to 2.5%. Let's just say it stays 2%, right? That's not going to dramatically increase year 1, year 10, year 20, year 30. You're making roughly $58 a month in that dividend for that $35,000 investment that has that 2% dividend in the stock market. In bonds, it definitely is not changing. You bought a 5%, you bought a 30-year US Treasury at a 5% coupon. You did that, 30 years ago, you're making $146 a month for the next 30 years, right? But now look at rental properties, year 1 cash flow. And again, I'm going all the way to a point where you're not getting any positive cash flow, which is not real right now. You actually do get positive cash flow for a JWB investment property. But let's just say that it was 0. In year 10, you're making $134 a month. In year 20, you're making $418 a month. Now you are lapping the dividend that you get in the stock market. You are lapping the coupon that you get for that 30-year US Treasury bond that you bought. And then if you go to year 30, this is when it just gets really fun. Your loan is paid off for this rental property, and your monthly cash flow now is $1,399. That was a $0 positive cash flow year 1 for rental properties that has now turned into this income generating asset when you need it in retirement, or maybe if this is going to be an asset for your future generations, your heirs will have $1,400 a month coming at year 30 without a loan on it. Compare that if you had set them up again with the stock, with the shares of the S&P, you'd be earning them $58 a month. The value didn't go up. So I hope people see that cash flow today is not the most important thing. Cash flow when you need it is why rental properties are such an attractive asset class.
What blows my mind on this is if you're under 10 years away, I don't know how to consider it, right? Like, except for the idea that, you're probably just going to have to be active, in things longer than you thought, right? Or at least for more than 10 years, if you're at 0 right now. But man, if I'm 10 years away from retirement and I'm looking at this thing, it's like, okay, so just 1-to-1, if I put the money in stocks right now versus bonds right now versus real estate right now, in just 10 years, I'm already at, more cash flow than stocks, a little bit less than bonds, but still with all those other options of like the refinancing and double down and doing all these other things that we can do, right? Like the thing that I wanted to tell you about, GC, is last night I'm at my, my best friend from middle school was like a amazing grill master and fisherman. So invites me over to like do this like awesome whole fish grilled out at his house. And we're sitting in his garden. He lives in an area called Buena Vista. That's like this like historic residential neighborhood in Miami with amazing homes and landscaping that just so happens that 4 blocks down the street, they built the design district, which is this like epic dining and entertainment district in Miami, right? So it's like a magical place to live a fully residential, lush tropical life with, urban living right, walking distance away, but they're going to be moving to Atlanta, right? So he was thinking, man, I bought this house. I've made a killing on this house, right? Like I put a big down payment on this house, and, Miami's appreciated like crazy from when I bought this. The design district didn't exist till now. So I'm going to sell this thing. I want to keep something here. I'm thinking about like partitioning off. It's a double lot. So keeping one lot and then selling the house so that he still has some land in Miami in this area that he'll never be able to afford again if he like gets out of it because it's going crazy, right? And I'm like, that's real interesting, Bill. Have you thought about, he's like, oh, because I need my debt to income ratio to be at a certain point and, all these different things. I'm like, man, that's really cool that you're thinking that way. To me, the sad thing is like, you would have this like land that isn't producing any kind of cash flow for you. It can be appreciating. It's going to be kind of a liability for you, right? Like you're going to be losing money on this thing. Have you thought about taking a HELOC out on your home, right? Like, I'm like, Billy, you can crunch these numbers on this house pull the equity of like all the, your down payment and all this stuff, likely still be able to rent this property out and be cash flow positive in Miami and have the down payment for the Atlanta home that you want, while, still maintaining this house long term and always being able to come back to it. And it blew his mind, right? Like people don't know these strategies. And I think of this like that's a 10-year investment for him, right? That is, he bought this house 10 years ago. And the idea that real estate has these other externalities of being able to leverage the equity that you've put in to keep the asset, keep it working for you, and still use that money to invest in other things, I find really, really interesting. But yeah, more than anything, I wanted to share with you that story because I was like super proud to come up with that.
Dude, way to go, man. I mean, your growth as an investor is just unreal, man. I mean, I think back about the runs that we would take early on, and, to where you are now, to be able to give that advice to help other people in your friends and family circle. And it's just what it's all about, man.
Yeah. Thanks, man. Let's get into some of this Q&A, bro.
Yeah.
Dean Curry has a question. Financial planners use a term called dollar cost investing. How does that relate, or does it even relate to owning real estate?
Dollar cost averaging typically is a term that is thrown about when the market goes down. So in the stock market, when the stock values tank, dollar cost averaging means that you buy more stock and then your cost basis for your stock investment is lower, and you're betting that over time it's going to rebound and then you'll actually make more profits over time. You don't usually hear dollar cost averaging thrown about as much in real estate, just simply because the market doesn't go down very often. I mean, the only time that the market went down in Jacksonville, and this is since they started really keeping great real estate value, really started tracking real estate values. Since 1978, the market only depreciated in Jacksonville one time. That was that stretch of years during the Great Recession. Absent of that, real estate values did not go down in Jacksonville. It's very similar for the rest of the country. So you just don't hear a lot of dollar cost averaging because values don't typically go down. The same thing with rents. Rents don't go down. So I guess in theory, you could use the same analysis and thought process, but you just don't hear it much.
Got it. We've got a not your average guest. So somebody joined in from the texts, and love to have you here. Just don't know what your name is because it defaults into that. But they're asking, would the dollar amount of dividends not increase? It would be 2% of the appreciated share value, ? Right? So they're talking about this slide here. How come the dividend doesn't increase over time?
That was a mistake by me. Whoever that savvy not your average guest is, they get the A+ award. I should have done that. I should have increased it. It really doesn't change the end, analysis here. Like, for example, at the 20-year mark, we can just fill it, we can just answer the question here, right? If we go and we say that the value is appreciated about 8% a year, I just know the numbers that I put together yesterday, that gets you to a stock value of about 150,000.
Mm-hmm.
So 150,000 with a 2% dividend gets you $3,000 a year, which on a monthly basis is about $250 a month.
And that's in 20 years?
Yeah, in 20 years. So great call. Thank you so much for pointing that out. You're 100% right, but still doesn't change the end result here, which is that early on in this process, you're going to earn a lot more from your rental property investment than the dividend that you get in the stock market.
Yeah. So even year 10, it's going to be comparable cash flow. And by year 20, you're getting destroyed.
Yep.
Or at least you're beating it up. You're winning if you're not an average investor.
Yeah. Year 10, you would have been less than $250 a month because your stocks wouldn't have appreciated as much. So call it, you'd be, $150, $175. So you'd be kind of in line with just the monthly cash flow from the rental property. Year 20, you're getting destroyed. Year 30, it's not even a contest.
Yeah. Cool. Awesome. Great call. Not your average investor text joiner. All right. We got a couple compliments. I'm just going to read through them. Dean Curry says, I love that JWB offers private money lending opportunities as low as 10K. Working with the JWB team, I have 6 active lends going on now. Thank you so much. And Denny Davis puts, Greg, I get frustrated when experts compare real estate as an investment versus stock market, and they are referring to real estate as a primary home, not investment real estate. These are two different things. Average investors do not pick up on this nuance. Leverage on rental real estate puts the investment on overdrive for the not your average investor.
Me and Denny, man, we just think so much alike. I get frustrated by the same thing that you're talking about, Denny. I was just reading an article in the Wall Street Journal yesterday talking about how, whoever they interviewed said that rental properties and owning real estate right now is, not as good as an investment because cash flows are depleting, because costs have risen and all this other stuff. And I'm like, yo, can you compare that to the returns that you would get from all 5 profit centers in the stock market? Like, end of story, right? If you hold on to this asset class, end of story, this asset class wins. And it doesn't take that long, right? If clients are thinking about buying properties with JWB, we ask them to commit to a 5-year hold because that sets them up for success, right? 5 years to be in an investment is very, very common for investors right now, right? Like, to ask yourself to commit to 5 years to being an investment, I'm sure if you look at your other investments, there's a high percentage of those that you're in for 5 years. So, I'm with you, Denny. There's so many things that the average investor does not understand out there. And I feel like the worst parts of rental properties gets used against us. And the best parts are for all of us in this community to enjoy, I guess.
Got it. All right. Tony D's got a question. For 2023, is it better to refi and pull out equity or do a HELOC? I have 2 mortgages at 4.5 and one at 4.25.
Great question, Anthony. By the way, Tony, I was driving down the road the other day and I saw Tony D's Pizzeria, and I was driving with my family. I was going to some basketball games, so I couldn't pull off the side of the road, but I really wanted to take a picture and send it to you. Tony D up in the house. So for 2023, is it better to refi and pull out equity or do a HELOC? We need to look at that together and put some numbers to it. A lot of that depends on what interest rates do in 2023. So, right now interest rates are, if you listen to the Fed, there's still going to be some upward pressure on rates going forward. So we don't exactly know what rates are going to do. So I would highly encourage you to reach out to my team. In fact, Max, Danica, Kate, our entire sales team, we were just talking about this question for another client who was asking a similar thing. So happy to put the numbers to it and help you figure out what the best thing for you is.
Cool. All right. Sankets has a question. I sometimes get advice to invest in REITs. Is that a good investment?
REITs have a place. It's very popular in terms of a way to get into real estate. What it does really, really well is it makes it super easy for you to invest in real estate, but it's not really owning real estate directly. A REIT is a stock for a real estate company. And so you're investing in the stock of that company. And, then it's just not as good. It's just not as profitable as if you have direct ownership, but it's a lot easier. And that's a gross generalization, but it's kind of how I feel about it.
So, if what we're talking about is asset allocation and somebody doesn't have enough for a down payment on a home, and, I guess a REIT is a way to invest in the asset class without owning the asset class. Would it be more of like a capital preservation play of less money if you're not going to be able to afford a home, so you're preserving capital because it's not going to be, I don't know, I'm trying to think
I just think it's access to the asset class. It's access to real estate is what the REIT has really solved. REITs pay dividends as well, so you get more income coming in, so there's certainly some advantages there. The concept of is it good or not is really compared to what your other investing alternatives are. So, if you don't have,
if we were to look at it on this last slide, it would perform more like the stocks, more like the stock line than the Jacksonville rental property line.
Yes, it would. It would be in between stocks and bonds.
Okay, cool. There you go.
Yep.
Ty Oladipo. Ty, welcome back to the show. Haven't seen you in a while. With the cash flow increasing over time, do you take into account the time value of money, inflation basically decreasing the value of the dollar?
Yes, great question, Ty. So we do take the time value of money into account here. So what Ty's talking about is, listen, in the stock market, you get your dividend day one. You start getting that $58 day one, $58 a month day one. And in bonds, you start getting that, I think it was $146, call it day one or whenever that bond payment is made to you, the coupon payment is made to you. So what he's saying is there's a real value for receiving that money day one versus waiting over time to receive money later on. And what you got to do is you got to look at what is the sum of the money. So if you receive the same amount of money today versus the same amount of money 5 years from now, then it would be much better for you to receive that money day one. And what you're seeing in this example is you're seeing a whole lot more money coming 5 years down the road, 10 years down the road, 20 years down the road, 30 years down the road for rental property investing. So even though you have to wait a little bit longer for it to overtake it, over time, your internal rate of return is much higher for a rental property than the investment in the stock market or in bonds.
There you go. GC, you showed up, buddy. You fought through the flu. You delivered some great slides, man. I thought that the concepts were clean. We had great questions from the community as always. Really want to, just commend you on doing a good job and thanking the community for being here for a full hour on a Tuesday right before Christmas. This is a true pleasure to be able to do, man.
You and me both, brother. You and me both. This takes me back to those aha moments that I had when I was working in corporate America 17 years ago. And I was like, oh my goodness, I think I've stumbled onto something that can change my life. And that was my mindset with putting these numbers to it. So I appreciate all of you for being as fired up about this as I am. I mean, I don't think there's any other part of my life other than work where I can just sit down and just get to talk about rental property investing, comparing it to how this can change your life over 10 years, 20 years, 30 years. So I appreciate the platform. Thank you guys for your incredible questions. Thanks for even fixing some of my numbers there. Not your average investor guest. I love it. I appreciate that. I hope you come back and find more mistakes that I make because we are all getting better here. We're all getting more educated and we're all setting ourselves up for financial independence here. So I appreciate all of you.
Love it. We got one more live show before the end of the year. So join us on Thursday for the JWB Rental Liquor Property of the Week. But for those of you that show up on Tuesdays, happy holidays, Merry Christmas. Good to have you. And do you see any final words here?
Well, so much to be thankful for. I'm going to save the big send off for Thursday. So I hope you come on Thursday for the property of the week. It's going to be a good one. I will tell you, this property of the week has something that we haven't done in 48 weeks for the property of the week. So I hope you show up there. If you don't, Merry Christmas, Happy Hanukkah, Happy Kwanzaa, Happy New Year's, but still show up on Thursday.
You got me curious, buddy. All right. We'll see you all on Thursday. And until then, if you want to get cash flow when it really matters, you can't think like an average investor. See you Thursday.